Hello there and welcome to the Breakfast Connect show on Africa Business Radio, the one show that wakes you up every single morning with the news in business, market and the economy. I am Rachel and I've got a very interesting guest joining me right now, and that's because many African governments undertook a wide range of steps to mitigate the economic and social disruptions caused by the COVID-19 pandemic. You don't need to be told, last year was something else for African countries and it has had significant implications for debt sustainability. I've got Selin Özyurt. She's a senior economist for France and Africa. She's going to give us insights into Africa's debt profile. Hello, Selin. Good morning. Thank you for joining me.
Hello. Good morning, Rachel. Thank you for inviting me.
So I came across your report, the one titled Emerging Markets Debt Relief, Kicking the Can Down the Road. Now, in that report, you pointed out the growing inequalities and vulnerabilities in the global economy as it concerns debt. Can you tell us, more about that one, just for backgrounds now?
Sure. The COVID-19 crisis triggered an unprecedented increase in public debt everywhere, all around the world. But more importantly, the global public debt was already rising. And it was a source of concern even before COVID-19, before the pandemic. And this was due to the commodity price slump as of 2015, but also to weak growth in advanced economies. But then with the COVID-19 crisis, as you said, government spending had to substantially increase to manage the sanitary crisis, of course, and also to absorb the economic shock. And at the same time, government revenues dried up, also in Africa, because of low commodity prices, low international demand, and restrictions to tourism, and all that made things worse, of course. And you talk about growing inequalities, and this is very important. This is very interesting also, that over the last decade, that cheap money did not bring it was not there for everybody, actually. The excess global liquidity did not translate into lower borrowing for all countries. And we show it in the report. The borrowing costs have almost halved for advanced economies, but on the other hand, they increased significantly for low-income countries, also in Africa. And also, in addition to this, there's a growing divergence in the debt service burden between advanced economies and the rest of the world. And we look at the share of debt service burden compared to government revenues, and that was around 6% over the last decade for more or less everybody. And now what happened is that this cost increase more than doubled for low-income countries. On the other hand, it decreased for advanced economies. So all in all, in the absence of a comprehensive solution, that heavy debt burdens may generate a permanent, long-lasting global divergence between rich and poor countries.
Right. So, of course, as you've mentioned, we saw African countries taking up several steps. They've increased health expenditures. They had to get into large fiscal stimulus packages. We saw automatic fiscal stabilizers, direct liquidity injection, and on and on and on. How exactly does this affect Africa? Where does it place Africa now?
Okay, in Africa, rising debt was already a growing concern over the past decade. And when we look at the numbers, we see that the average debt to GDP ratios have doubled since 2012 to near 70% of GDP. But again, when we talk about Africa, we talk about more than 50 different countries. So the situation is very heterogeneous from one country to another. And what is a source of concern for us is the composition of African debt has significantly changed over time. The share of commercial creditors in the external debt stock increased dramatically since 2000. So their share was 17% in 2000, and now we are more than 40% of the debt is held by commercial creditors. And there I also mean all the Eurobond emissions, because at least 21 African countries had access to international capital markets since 2000. So they could emit Eurobonds on international markets. And the others, which could not have access to international capital markets, they have been increasingly borrowing from China under the form of direct loans, but also collateralized loans over commodities. So all this made it hard to track because especially the Chinese debt has very limited transparency.
Yeah.
And we are worried about that shift in the composition of creditors towards more private creditors, because this makes it difficult to implement a debt relief or debt restructuring when the debt becomes really unmanageable, unsustainable. And we also see that it has some unfavorable consequences, like during the DSSI, debt payment forgiveness initiatives. Some countries like Kenya and Ghana, they were reluctant to ask for debt relief because they were scared of losing market access and having a bad reputation.
Right. So I'm still going to bring you back to the debt relief and debt restructuring. But just before that, if you look at what we went through last year, comparing it to where we're at this year, it seems like the dust is beginning to settle a little bit, even though we still have concerns around the Delta variant of the virus. But then again, African countries, African governments, they're trying to, go back to financing development. But the big question is, how can they do this without sinking deeper into debt, Selin?
No, this is a very hard question, but let me just emphasize that debt is itself, it's not necessarily something bad. There is good debt and bad debt.
Of course.
So you need to make the difference. For instance, if you borrow for financing infrastructure projects that will raise potential growth, create jobs.
Debt, right?
Yeah, exactly. That will achieve a transition towards a low carbon economy. So then we talk about the sustainable model or diversing the economy away from commodities. This would be the good debt. What would be the bad debt? Would be borrowing for financing chronic budget deficits. Because there the countries need to tackle the root causes of this unsustainable debt accumulation. In the history also, we saw after the episodes of debt relief, the same countries got into the same debt trap again and again. So in this sense, we need to understand where the problem comes from. And most of the time, the usual suspects are over-reliance on commodity exports, insufficient revenue mobilization, or corruption, and the list is long, of course. But the other point, to answer directly your question, the solution to that and the good alternative would be, of course, attracting foreign direct investment because it's a reliable source of international capital inflows, more stable than portfolio inflows that could leave the country any time. But of course, this is easier said than done.
Right.
How do you attract, in the midst of a crisis, how do you attract foreign direct investment? You need, first of all, have a predictable business environment and foster confidence for this. And as you said, the sanitary crisis also suggests that a greater vaccine availability for Africa would be also key to establish that predictable business environment to attract foreign investment that involves long-term commitment in Africa.
Now, since you're talking about, what should be done, I'm going to have to drag you back to debt restructuring that you mentioned earlier. Do you have any direct advice to international communities on the debt problem? What could be done to make it, move along in a better direction, especially as it concerns debt resolution? Are there examples where decisive debt resolution worked and, led to better economic conditions?
This is a quite tricky issue. First of all, step in the right direction, but its scope was limited because it covered only official debt owed to official creditors. So as I mentioned, the share of commercial creditors is getting bigger and bigger. And also that initiative did not suggest a solution, did not include emerging countries like Tunisia or Gabon. which really needed such a relief. So a good step would be already broadening the scope of such an initiative, at least for official debt. But at the same time, I should mention that G20 initiative had the merit of bringing China finally into the debt restructuring talks.
Okay.
But now we are still talking, of course, about measures to deal with liquidity problems. But now what is next to do is to deal with solvency problems. So to restructure that if it's needed. So here we have that new initiative of common framework. So that has the ambition of bringing together everybody, so commercial creditors and China, and restructure debt under the same conditions. And this is very complicated, very difficult, and it still has to be tested in Africa with countries with Zambia, Ethiopia, and Chad. And you ask me, like, other good examples. Restructuring is a painful process. It's painful for everybody, for the creditors and for the country in question. So it's hard. But one should not wait until it's too late, actually, until the last moment. So it's important that countries are transparent about how much they owe, what is their situation, and to ask for a realistic haircut. Because we also see some research showing that compared to timely debt restructuring, waiting until the last moment, until the default occurs, has disastrous consequences in terms of income losses, but also for investment and private sector credit and capital inflows. So countries need to be realistic and transparent and address the issue all together at once. Also, the experience from the past decades, also from Latin America, shows that a country tends to go through multiple debt restructurations over years and years, and all that to end up in total default. So that will be very disastrous, because we don't want Africa to go through a lost decade after COVID-19.
Yeah. All right. So we have, we still, I think our major concern in Africa, or, one thing we're really battling with is trying to maintain that level of liquidity, that level that's going to support the local economy. And then we still have the problem of not having enough cash. And of course, borrowing seems to be the only option. How do you even approach this sort of dichotomy?
Yeah, this is, as I said, Africa should not be trapped in a low growth and high debt loop after COVID-19. And as you said, because of limited fiscal space and also structurally weak revenue base, most countries could not engage in large-scale fiscal stimulus to ignite growth. Right. South Africa was an exception, but now South Africa has to struggle with that dramatic increase in debt. So this is quite hard. But still, we should not forget that economic growth, is the part of the equation for debt sustainability. This is why countries should not cut public investment or cutting. It's easier to cut in such a crisis times. It's of course easier to cut spending than collecting more fiscal revenues, especially you mentioned automatic stabilizers and also all the external money coming from oil exports and so on. So that becomes difficult. But countries should not cut, especially during a sanitary crisis, public spending, because that can have, in the end, counterproductive consequences by putting a brake on growth, but also fueling social tensions and political instability. Right. And all these would have the consequences of raising the country's borrowing cost down the road by credit rating downgrades or by increasing the spreads. So what would be, this is a dilemma, this is very hard, I totally agree. And a way out would be proactive debt management. for reprofiling that and to get some breathing space. In this sense, I can mention Benin and Ivory Coast as good examples for that debt management, because those countries, they don't wait until bad times. Like when market conditions are favorable, they buy their own debt to lengthen maturities. And this could be a smart way of buying some time during difficult times when automatic stabilizers are not at work, for instance.
Right. This makes a lot of sense. Countries should not cut public investment, even though it's really quite tricky, especially at times like this.
Yeah.
You know, the need to engage in proactive debt management like Benin Republic and Ivory Coast. Now, just before I let you go, Selin, taking you back to debt resolution again, how quickly do you see, emerging markets that really need this process? How quickly do you see us being involved in this debt resolution process?
It's our publication has the title of "Kicking the Can Down the Road." So it means this is a very complicated process.
Yeah.
It also requires full transparency. So governments need to be transparent about their existing debt, including the hidden debt. Here I mean state guaranteed loans or the arrears from public companies, because creditors need to have a clear picture to make informed decisions on whether or not they are going to restructure. But also they need to know what a country owes to all of the lenders, so including China.
Okay.
And it's very hard to convince also on the Chinese side to reveal all the investments which are backed with strategic assets. So the whole setup is quite difficult. But definitely international community should move before it's too late, because the risk is doing too little and too late and to wait until the last moment. This is very complicated, but we are optimistic, and we are optimistic also for at least for official debt, bilateral debt. And again, that brings me to the transparency issue, because to secure loans from the IMF, the debt needs to be sustainable. Our countries need to take the necessary steps to restructure, to address the unsustainability problems. So again, what governments can do to speed up the process is being transparent and open about how much they owe and who they owe, and to have a realistic haircut to put their growth on a sustainable footing again.
All right. I'm very optimistic too, Selin. I do hope that emerging markets will, find ways to better manage that crisis quickly. That's the word. And efficiently as well, to get Africa back on track for a resilient economy. Thank you so much, Selin. It's been amazing having this conversation with you.
Thank you very much.
And I do hope that you'll be available for further conversations around this.
Sure.
All right. And I've been talking with Selin Özyurt. She's a senior economist for France and Africa. She has given us insight into Africa's debt profile. Thank you so much, Selin. And it's still the Breakfast Connection on Africa Business Radio. Rachel, we'll be right back in a moment. Stay here.